Good morning and welcome to the second session of National Income Accounting Chapter 8. Now in this session, we are going to see the different methods that are used to calculate the GDP or the gross domestic product. In the previous chapter, we tried to understand the various fundamental concepts that are involved in national income accounting. In this chapter, we will try to understand what are the methods that are being used worldwide by leading economists in order to calculate the GDP of the country. So going forward, let's first try to understand the product or the value added method. Now, what does the product or the value added method tell us? It tells us the net contribution made by a firm, and it is calculated on the basis of aggregate annual value of goods and services. Now, what does this mean to us? In a simple manner, if there is a company called X and that company starts manufacturing 100,000 goods, so it manufactures 100,000 goods per year at the rate of 10 rupees. That is the value of a good. So what is the total contribution that it has made? It has made value worth of 10 lakh rupees to the government, to the economy. This is where the product or the value added method comes into picture. Now if you look here, what the company has tried to do is that it has been doing its regular business. It has been into manufacturing and it is manufacturing a good, let's say an FMCG product itself. The value of the good is 10 rupees and they have calculated and contributed 10 lakh rupees to the nation's economy. Similarly, in India, there are hundreds and thousands of industries who are involved in manufacturing. What they typically try to do is that they manufacture goods at their maximum level. So it might be a healthcare product, an automobile product, a chemical product, a toothpaste, an FMCG, whatever white goods that they are producing, they are trying to contribute to the nation in the form of final goods. Now we have seen in the last chapter that in the contribution of final goods means the goods that will be directly consumed by the consumers. It is not going for any further stage of production. So the final goods are the goods that are going to be consumed by the consumer. So these are the people who contribute to the final goods. They manufacture so much and they contribute to the nation. The contribution to the nation is always calculated by the aggregate annual value of goods and services. So what is the aggregate annual value? 10 lakh rupees. So the contribution is calculated in the form of revenue. It is not just calculated in the form of products. Every product will have a price. So when you multiply the total number of products into that final value, you will get an aggregate value that is contributed towards the nation's growth. So this is the concept behind product or value added method. Now moving forward, the gross value added method. What is this gross value added method? Now if you try to understand the gross value added method, we are going to add the value of depreciation and then we are also going to see the value of production of the firm and the inventory. Now if you look here, this gross value added itself, the word gross, that means we have not come to net. It is an overall contribution. So for any product in this world, is there something called as depreciation that is involved? The answer is yes. So there is a depreciation factor. Depreciation is very, very important because the value of the product does not remain the same throughout the year, throughout its lifetime. It will try to come down over a period of time. So now what happens is that as you start manufacturing, the value of the product does not remain constant. It will try to come down. So when you do the gross value added, you also need to take in your mind the concept of depreciation. How much will the product value come down? So the depreciation factor has to be taken into account. Then the value of production of the firm. So if I make a value worth of 1 crore or 10 crores or 100 crores, you also need to look into the depreciation, and then you need to start calculating the value. And last but not the least, the word called as inventory. Why inventory? I have lot of stock. Even that stock or the material will have some value. I cannot disregard it, or I cannot go away from it. So that is where it becomes very, very important for every firm in this world to calculate depreciation, the production, and also the stock or the inventory that they have kept. Using that method only, they will be able to come to the gross value added. Now, if you try to understand the calculation, you will see here gross value added 1 plus 2, like this we go till n number of values. So what is the final value? GDP is equal to gross value added at a particular time value, which means to say that over a period of time, say for 1 year, say for 2 years, say for 10 years, whatever we are going to calculate, we are going to take a time period and calculate. So the gross value added is not at a moment, at an instant. It is going to be a lifelong, a time period bound oriented exercise. It is going to go over a flow. And then we are going to calculate what is going to be the gross value that is added up. But what is very, very important for all of us to understand? Depreciation, inventory, and the production concept, because all these factors are going to stick with you in terms of the national income concept. Now, moving forward, we are also going to talk about the word called as investment. Why investment is very, very important. Now, if you look at investment, addition of stock to the capital is known as investment. So what does that exact investment means to us? Now, when you go here and start understanding, you look at the picture, you will be interested to find out the factor that everybody wants to put in money into some growth vertical. Let's say that if I have an X amount of money and I want to invest, I would prefer investing in healthcare. Now, I want to see that the vertical grows and starts creating n number of income for me. Similarly, for the organizations, if you start looking, they would also try to invest some money, and in the form of stock of the capital, addition to the stock of the capital, which will be known as investment. Now, this is very, very important. Why? Because I would not just try to build my investment on anything and every sector. I would try to build up my stock on a particular sector and start increasing my inventory levels. Accumulation of inventory. I want to accumulate my raw materials, my necessary inputs, so that I will be able to take it forward towards growth. So investment is a concept which you need to understand, not by just putting money into some sector. It is a value add. It is a growth oriented process. So it starts growing step by step into a particular level, and you start accumulating the inventory, you start accumulating the stock, so that over a period of time the wealth grows and the company also makes a progress. It is an unplanned decumulation of inventory also. Sometimes that is also a factor that we need to understand. We wouldn't have planned much. The company wouldn't have planned much. So what they would have just kept in the mind is that just keep on adding the stock, or sometimes just delete certain part of it and keep a certain part of the stock, so that at the end of the day there is an amount of growth, there is an amount of investment into the areas of interest. So the national income accounting says that investment is not just part of putting money. It is all about investing into sector specific area through which growth can be achieved in the long run. So you need to keep investing in a particular sector, in a particular manner, where you start accumulating your inventory. That is why it is very, very important here. Addition to the stock of the capital. We are not just doing addition to the capital, we are doing addition to the stock of the capital. So there is a stock, you further add value to that stock. You are going to invest money to the stock factor. So that is what is investment all about. Then how you start thinking about in the long run, how we will start adding value to the company in terms of inventory. Now moving forward, we have the gross domestic product, the most interesting factor of economics. Everybody in this world is interested to talk about this one single topic called as GDP. What is this GDP? Now everybody knows GDP stands for gross domestic product. But if you are going to define GDP in economics, it is equal to sum of total gross value added of all firms in the economy. Now this is quite a simple but yet a complicated word when it comes to a layman term altogether. What is the meaning? Sum total, that is understandable. That means we are adding up all. Of gross value added. In the previous slide we saw what is a gross value added, taking all the inventories accumulation together. Of all the firms, that means all the industries in the country, in the economy. So of all the firms in the country, in the economy, which puts up together, that will lead us to the calculation called as GDP altogether. So this is why it is important. Now the GDP, what does it stand for? What does it typically talk in terms of a layman term? Now GDP tells the production capacity, the export capacity, the consumption capacity to the people, to the nation. So when you talk about India and when you look into the current scenario where the GDP might just contribute about 4.5% of India's GDP. That means what we are trying to see, the GDP is trying to shrink down. Why? Because of the consumption coming down, production coming down. When automatically these numbers move to 9% or it moves to 10% and all those factors, that means the GDP is making a rapid progress altogether. But the concept of GDP is important because that measures the health of the nation. For all of us, right from our childhood, the most important thing or a critical factor is a word called as progress card. Whenever this progress card or report card comes to our home, we are afraid. Why we are afraid? Because that is going to tell about our performance to our parents. We might be good in studies, we might be very good in academics, but how are we going to be measured? We are going to be measured through that progress card, through the marks that we have obtained. Similarly, for a nation, however good it is, however strong it is, however export oriented it is, however futuristic it is going to be measured using the GDP. People are going to look into the nation by the value of GDP, by the contribution made by the GDP. So that is why GDP is a direct indicator of growth for any nation in this world. People are completely interested. Whenever they see these numbers in the newspaper, they want to make a presence. They want to understand it. They want to know what is the current stand of that country. So moving forward, expenditure method. Now this is the second method that we are going to use in terms of calculating the GDP. So that's why I say it's an alternative method or a way to calculate GDP. Now what is this expenditure method all about? For any country in this world, expenditure is something that cannot be forgotten. For a country like India, when there are a lot of firms, organization, people, process, factors, everything put together, there will be an expenditure because we are spending huge amount of money in terms of production, in terms of packaging, in terms of exporting it. So there will be an expenditure that will be taken into account. So that is a very, very important concept here, that there will be a methodology where we need to calculate our expenditure factor. Now, why is this expenditure coming into picture? It is because of the very simple thought called as demand. Demand actually tries to create an expenditure factor. The demand function is very, very important. Why? Because if a product has demand, that means the manufacturer will try to make it more. The country will start emphasizing on that sector. So automatically what will happen, there will be a huge amount of production that will be stepped up in terms of demand. So when the demand starts going up, the production will also start going up for that particular product. Automatically there will be an expense also that will go up with that particular production. So what happens here is that the demand side of the product values or matters a lot in expenditure method. The more we want to export, the more we want to process, the more we want to package it outside, automatically an expense is also imbibed into it. So that is why in expenditure method, we always keep in our mind that the concept of expenses towards the demand side. So that is very, very important. Concept of expenses towards the demand side. Now for a country like India, let's say that we export to more than 100 odd nations in this world. So we manufacture cotton, we are one of the leading producers of dairy, we are also one of the leading producers of automotive components, we are leather products leader. So we have different types of manufacturing that happens in our country, and we export all these goods from the Indian subcontinent to the various countries across the globe. But why do we do this? Because we try to understand that exports in turn will give us revenue. So when we manufacture this product, there is some expense that is associated with it. The government will try to understand the expenses that are associated with each and every product. They will also calculate the demand that is associated with each and every product, and then finally allow the sector or the firm to start getting into the manufacturing of it, and then we will calculate the expenditure involved and we will progress in terms of export. So that is what we call as the expenditure method altogether. Now moving forward, what is the calculation method for this particular thing? Now this is a very, very important factor. This 4 letters C plus I plus G plus X. This is the base at which the GDP calculation begins. Sir, what are these letters? What do they mean to us? C stands for consumption. C stands for consumption. Now, what does the letter I stand for? I stands for income or investment. So we try to put in the factor here. G stands for government. X stands for exports. So these are the factors through which what we are going to stand in terms of our GDP calculation. Why this is important? Consumption plus income plus government plus the export factors matters a lot. In this factor, income or investment, both are important. They are simultaneously used. So here, let us go with investment itself, since we have studied the word investment. So consumption plus investment plus government plus exports matter to us in terms of calculating the GDP. Now let's start understanding the calculation method altogether. If you look into the board, you will start understanding that all these factors are being done over a period of time. They are not just calculated at an instant or at a moment. They are being calculated over a period of time. So they are at a particular level. When we start doing it, you also would start seeing the word M coming into picture. M stands for imports. So at the end of the day, what is the calculation or the formula to calculate the GDP? This is that one. C plus I plus G plus X minus M. consumption plus investment plus government plus exports minus imports. That is the most important factor. So the calculation of GDP will happen when you subtract this entire value minus the imports. So why? Because we are calculative only in terms of export. Imports means we are spending money. Exports means we are receiving money. Imports means we will be spending money. So the simple calculation here is that add all the revenue together and subtract the expenses. So when you subtract that expense factor here is imports. So when you subtract imports from consumption, investment, government and your export factor, you will be able to calculate the base value of the GDP. So this is the formula that is being used by the Planning Commission, by the Ministry of Finance and other institutions and organizations to arrive at the basic GDP value. Now moving forward, this would be the end of the session for today. Thank you for joining me on this wonderful session. Hope that you were able to understand and get some information in terms of calculation of GDP and the various factors that are involved in the national income accounting. I hope and believe that this would have enlightened you about the concepts of GDP and the various factors that are governing our country. Hope to see you again in the next session with new ideas and new enthusiasm altogether. Until then, thank you, goodbye, and all the best for you. Thank you once again.